titled Beyond the Peg: How Stablecoins Unlock a New Financial Architecture. Introduction. Stablecoins began as a workaround. Designed to mimic the value of fiat currencies like the US dollar, they offered traders a faster, more efficient way to move capital on-chain without needing to cash out to a bank. In their early days, stablecoins like Tether, USDT, and USDC served a narrow purpose: reduce volatility in crypto trading pairs and eliminate fiat on-ramp delays. But that initial purpose was only a prelude. Today, stablecoins are no longer just digital equivalents of paper money. They are becoming programmable primitives, tools that not only hold value, but actively shape how that value moves, when it moves, and under what conditions. Whether it's paying employees by the second, executing automated trades across DeFi protocols, or serving as global liquidity rails for countries lacking stable fiat systems, stablecoins have outgrown their peg. The peg still matters, but it's no longer the story. The new story is architecture. A stablecoin today is a high-performance module in an open-source monetary system. It is liquid, interoperable, composable, and permissionless. It can carry logic, enforce terms, and stream across borders 24/7. And as regulatory clarity improves, stablecoins are gaining a level of institutional legitimacy that few other crypto assets can claim. This exposition explores how stablecoins have evolved from passive reflections of fiat into active components of a new financial operating system, one that challenges the assumptions of traditional banking, rewires liquidity flows, and redefines how money is created, used, and coordinated globally. Let's begin with the most obvious advantage: efficiency. 2. The efficiency layer. At the heart of stablecoin adoption is a powerful, unglamorous truth: they're cheaper, faster, and more capital efficient than anything the legacy system offers. In traditional finance, moving money is a multi-day affair. It passes through banks, processors, clearinghouses, and sometimes borders, each layer clipping a fee and introducing delay. In contrast, stablecoins move at internet speed, often for a fraction of a cent. On networks like Solana, transaction costs can dip as low as 0.00025 cents. Tron and Arbitrum offer similarly low-fee environments, making it economically rational to move stablecoins frequently, even in small amounts. This stands in stark contrast to wire transfers, SWIFT payments, or even credit card rails, where fees can eat 1 to 3% of each transaction, and settlements can take days. But efficiency isn't just about low fees, it's about keeping more of your principal in play. When you don't lose capital to intermediaries, you preserve more of it for yield generation, reinvestment, or real-time payments. Stablecoins create a closed-loop system where capital loss to friction is minimized and return on capital can be maximized across short time intervals. And that leads to a second-order effect: yield optimization. In DeFi, money never sleeps. Yield opportunities open and close across protocols, sometimes within hours. With stablecoins, liquidity can shift in near real time to chase the best returns, creating a dynamic, hyper-efficient environment where money is constantly being redeployed to its most productive use. Put simply, stablecoins turn capital from a static balance into a fluid instrument, and that fluidity gives rise to a deeper function: velocity. Let's explore that next. 3. Velocity as value. Stablecoins aren't just fast, they're always fast. This matters more than it first appears. Traditional finance operates in time zones and market hours. Capital often sits idle overnight, on weekends, or while waiting for batch settlements. But stablecoins operate on-chain, around the clock, with no banking hours, no cutoff times, and no intermediary delays. That makes money more available, not just in a temporal sense, but in a systemic sense. This is where the concept of velocity takes on a new meaning. Economists define the velocity of money as the frequency with which a unit of currency is used in transactions over a period of time. In legacy systems, velocity is constrained by physical infrastructure and bureaucratic inertia. In DeFi, stablecoins obliterate those bottlenecks. 1. Always-on liquidity. Capital can flow globally at the speed of code. If a lending protocol in Asia opens up better yields, stablecoin holders in Europe can reallocate funds instantly. This 24/7 liquidity loop creates a kind of global yield relay where capital rotates geographically, algorithmically, and opportunistically. The more frictionless the transfer, the more useful each unit of capital becomes. 2. Streaming payments. Stablecoins also introduce an entirely new payment paradigm: streaming capital. Instead of paying someone hourly, weekly, or monthly, a smart contract can stream tiny bits of money per second. This isn't hypothetical. Protocols like Superfluid and Sablier already enable it. Imagine freelancers being paid in real time as they work, or consultants billing clients per second of Zoom time. Streaming payments make liquidity granular, transforming fixed payouts into fluid flows. For laborers, it means instant access to earned income. For businesses, it enables precision billing, real-time accounting, and improved cash flow management. 3. DeFi composability. Finally, stablecoins are composable. They can plug into lending markets, DEXs, DOs, NFT platforms, and cross-chain bridges without requiring new infrastructure. This allows them to be deployed, borrowed, staked, or pooled in seconds across thousands of applications. Where traditional currencies require banks, apps, and APIs to move between use cases, stablecoins function like financial Lego blocks, reusable, reprogrammable, and immediately liquid. This composability supercharges the velocity of capital, not just across users, but across systems. In this world, velocity isn't just a feature, it's a competitive edge. The faster capital moves, the more economic activity it enables. The more programmable that velocity becomes, the more it rewires how trust, labor, and value are coordinated. That brings us to the next layer, programmability itself. Stablecoins don't just move money, they define the logic behind how money should move. Section 4, programmable money and new coordination models. Traditional currencies move when people move them. Stablecoins move when logic tells them to. That single shift from manual to programmable unlocks an entirely new paradigm for how value is coordinated. With smart contracts and stablecoins, money isn't just sent, it's orchestrated. Rules, conditions, triggers, and constraints can be embedded directly into the money itself. In this world, contracts aren't interpreted, they're executed. Let's look at what this means in practice. 1. Smart contract integrations. A stablecoin inside a smart contract doesn't just sit idle, it acts. It can be programmed to pay out only when predefined milestones are hit, e.g. escrow for services, rebalance between DeFi protocols based on yield thresholds, split earnings automatically among multiple stakeholders. This means stablecoins don't just serve as tokens of value, they become instructional units within programmable economic environments. From payroll to liquidity farming, the logic layer is now native to the asset. Real-time trust without intermediaries. Historically, trust was enforced by institutions, banks, notaries, legal systems. With stablecoins and smart contracts, trust can be coded. That allows for atomic transactions, where conditions are verified and settled without third parties. Example, a legal consultant gets paid per minute during a Zoom call. As the timer ticks, the client's stablecoin stream flows directly to the consultant's wallet. No invoices, no net 30, no clerical disputes, just autonomous execution. This is trustless trust. Not because you trust no one, but because the contract itself makes trust unnecessary. 3. Tokenized labor and services. In programmable economies, labor itself becomes tokenized. Workers or contributors can receive tokenized shares of revenue, reputation-based bonuses, streaming stablecoin compensation. This opens the door to microeconomies and on-chain work platforms where performance and compensation are dynamically linked through code. Platforms can auto-allocate stablecoin budgets, handle contributor payouts, and adjust incentives based on real-time inputs. Even recurring subscriptions or licensing deals can use stablecoins to dynamically allocate royalties without needing a payment processor. In essence, programmable stablecoins let us embed logic into liquidity, turning money from a passive medium into an active, rule-bound agent. This enables new models of coordination, ones that are faster, fairer, and natively digital. But this new functionality needs one more thing to scale: legal and regulatory permission to operate. Let's now explore how regulation is catching up, and in some cases, actively paving the road. Section 5, Regulatory Clarity and the Rise of Sovereign Templates. For stablecoins to evolve from DeFi experiment to global infrastructure, they must pass a critical test: sovereign legitimacy. Until recently, regulators viewed stablecoins with skepticism, seeing them as speculative tools or threats to monetary sovereignty. But that posture is changing. As governments recognize the potential of stablecoins to enhance payment systems, extend dollar influence, and support financial inclusion, a new wave of pro-stablecoin policy frameworks is taking shape. Two major regulatory initiatives now serve as blueprints for how sovereign entities might integrate or co-opt the stablecoin model. 1. The Genius Act, U.S. Dollar stablecoins go legit. Passed in July 2025, the Genius Act marked a turning point. It legitimized dollar-backed stablecoin issuance under a regulated framework, requiring registration with U.S. financial authorities, e.g., the OCC, full reserve backing, often held in U.S. treasuries, audit transparency and operational oversight. Crucially, it extended these requirements to foreign issuers wishing to offer stablecoins in U.S. markets, meaning dollar-pegged stablecoins around the world must effectively plug into the U.S. financial system. This grants the U.S. a powerful export product, not just the dollar itself, but the digital rails for its global distribution. It's a modern update to the Eurodollar system, now running on blockchains instead of offshore bank ledgers. 2. MiCA EU. Europe builds a euro-backed defense layer. Europe's response came in the form of MiCA, Markets and Crypto Assets Regulation, finalized in 2024. While more conservative than Genius, MiCA provides a regulatory sandbox for euro-denominated stablecoins. Key requirements: issuers must be licensed electronic money institutions or banks. Full reserves and regular audits are mandatory. Stablecoin white papers must meet disclosure standards. MiCA's intent is clear: prevent dollar-denominated stablecoins from dominating European payments, and reassert the euro's relevance in digital form. 3. The global copy-paste effect. Perhaps most importantly, these regulatory models are template-ready. Just as tax havens once exported legal structures for incorporation, sovereigns can now export stablecoin frameworks. Emerging markets, facing broken local currencies and weak banking systems, may find it easier to import a working template than reinvent from scratch. This means regulation is not just catching up to stablecoins, it's beginning to standardize them, much like HTTP standardized how we interact with websites. And that standardization has massive implications for the structure of global finance, especially when we consider how offshore institutions might exploit these frameworks to revive and evolve the Eurodollar system. Let's explore that next in Section 6, the Eurodollar 2.0 thesis. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. The Eurodollar 2.0 thesis. The original Eurodollar system emerged in the mid-20th century as a byproduct of U.S. dollar dominance, where foreign banks outside U.S. jurisdiction held and lent U.S. dollars offshore. This created a massive shadow liquidity network, dollar credit without domestic oversight, but with global impact. Stablecoins are now giving this system a digital upgrade. We call it Eurodollar 2.0, but it's more than a reboot. It's a programmable, interoperable, and globally accessible dollar layer built by private actors, sovereign entities, and decentralized protocols alike. Here's how it works and why it matters. 1. Offshore issuers plus onshore collateral equals synthetic dollar scale. Under the Genius Act and similar frameworks, foreign institutions can issue dollar stablecoins, as long as they register appropriately and back those coins with U.S.-based reserves, e.g., treasuries or dollar deposits. This creates a unique arrangement. Issuance is decentralized globally, backing is centralized in the U.S., liquidity becomes borderless. It's a sovereign symbiosis. Offshore capital markets extend U.S. monetary reach in exchange for access to dollar-based collateral instruments. And with stablecoins, this can happen on-chain, in real time, and without banking hours. Sovereign participation via treasuries as collateral. Tokenized stablecoins backed by U.S. treasuries provide a capital-efficient reserve mechanism. This opens the door for sovereign wealth funds to issue their own branded stablecoins, emerging markets to offer local DeFi rails without needing their own currency stability, treasury demand to increase as more collateral is required to support stablecoin float. Ironically, stablecoins may rescue the U.S. bond market from fading demand by anchoring their value in treasuries that get locked up as trust collateral. 3. A new global liquidity loop. In the Eurodollar 2.0 system, stablecoins flow across DeFi, fintech, and remittance platforms. Demand for U.S. treasuries grows not as sovereign debt, but as digital backing assets. Offshore institutions become distribution hubs for on-chain dollar liquidity. Real-world yield, tokenized labor, and digital payments feed into a dollar-denominated ecosystem. This creates a global feedback loop where demand for stablecoins increases demand for dollar assets, which in turn reinforces dollar primacy, even in a multipolar monetary world. In short, stablecoins have the potential to digitally enshrine dollar hegemony, not by mandate, but by market adoption. And that brings us to a deeper shift. Stablecoins are no longer just proxies for fiat. They're becoming a new class of financial infrastructure in their own right. Let's explore that transformation next. Section 7, From Currency Clone to Financial Infrastructure. Stablecoins began as currency clones, digital wrappers that mimicked the value of fiat but relied on centralized custodians and simple mechanics. Today, they are evolving into modular infrastructure components, programmable, composable, and foundational to a new financial operating system. This shift is both technological and philosophical. It signals the arrival of a monetary layer where money is not just stored or spent. It is streamed, governed, collateralized, and orchestrated. Here's how that transition is playing out. 1. From representation to enablement. Legacy stablecoins like USDT and early USDC merely represented fiat. They served as placeholders. But the new wave of stablecoins, e.g. Frax, GHO, Athena USD, are enabling functions far beyond mirroring a unit of account. These include self-custody and collateralization mechanisms, dynamic minting and burning tied to DeFi market conditions, integration into governance, yield-bearing protocols, and cross-chain liquidity. As a result, stablecoins are becoming permissionless modules that can plug into any financial system with minimal overhead and maximum control. 2. Cross-network utility and infrastructure portability. Interoperability is no longer a wish list item, it's standard practice. Stablecoins now exist across Ethereum mainnet and Layer 2s, Arbitrum, Optimism, Base, non-EVM chains, Solana, Tron, Cosmos, bridged and native forms, e.g. USDC E versus native USDC on Avalanche. This enables a cross-network financial operating system where the same unit of account can move freely across chains, apps, and ecosystems, comparable to the way HTTP packets flow across the internet. Stablecoins are thus infrastructure portable. They carry their utility wherever liquidity flows. 3. Future use cases, beyond crypto natives. As the infrastructure matures, stablecoins are poised to serve users outside crypto entirely. Potential use cases include corporate payroll, real-time wage streaming with tax auto-deductions, remittances, borderless, instant settlement without correspondent banks, financial inclusion, mobile native savings accounts for the unbanked, machine-to-machine payments, IoT devices paying each other in stablecoins for bandwidth, energy, or compute usage. Supply chain finance, smart contracts releasing stablecoin-based payments upon verified delivery milestones. In each case, the stablecoin functions not as a mirror of fiat, but as native liquidity in a programmable value stack. In short, stablecoins are evolving from financial tools into financial terrain, the base layer upon which next-generation applications, protocols, and institutions will build. Which brings us to the final question: what does this unlock? 8. Conclusion. From mirror to motor, the stablecoin shift. The journey of stablecoins reflects a deeper transformation in the role of money. What began as a clever workaround, a way to peg digital assets to fiat, has become a launchpad for reimagining the very architecture of finance. Stablecoins no longer simply mirror fiat. They now move with purpose, respond to logic, and interact natively with a programmable world. In doing so, they collapse transaction costs across borders, unlock 24/7 liquidity with global reach, automate trust and execution through code, standardize and accelerate the Eurodollar 2.0 system, blur the lines between currency, contract, and capital coordination. This isn't just financial evolution, it's architectural realignment. Stablecoins are becoming the connective tissue of a post-banking financial era, decentralized where possible, regulated where necessary, and interoperable by design. In a world where money is programmable, composable, and global by default, we move from scarcity models and compliance bottlenecks to fluid systems of value exchange, open, modular, and real-time. The peg may have been the origin story, but the real story now is what comes after the peg, a financial operating system where capital is no longer bound by time, borders, or bureaucracy. Welcome to the new monetary substrate. It's not a coin, it's a protocol.